You know who you are, Faye, Graham, Jerry and Kathy. Come ahead. While they're taking their seats, you will see spread around and an exhibitor outside. A partner charity of this event is Child Vision. Child Vision is an equine therapy team challenge for kids. They run a program aimed at corporates where you can experience the power, disabled kids, of equine therapy. You ride a horse blindfolded with only your colleagues to guide you. It's a great example of the S in S&G. So please do take one of these leaflets home with you, and we'd ask you to give it some consideration. Also, I did get 2 questions on the Slido, which actually will be transferable to another panel, but there's a poll at the moment. Does your organisation conduct any community engagement activities apart from those directly connected with the business, yes or no? So please do submit your questions to the panel, which now is going to, so you heard about access to funds from Aidan and all the sweet spots that he outlined of the advantages of making yourself eligible for Article 9 funding and so on. So let me introduce our panel in no particular order. Beside me, Jerry Moriarty is CEO of the Irish Association of Pension Funds since I was a child, isn't that right? And of course is one of the foremost experts in all aspects of regulations of the pension industry, and together the association are responsible for over 135 billion in retirement savings, and obviously fundamental to a lot of people who are depending on their activity to have no longer defined benefit but defined contribution pensions. Then we have at the far end, we have representing Amundi Ireland, employing hundreds of people in Ireland. Their head of retail distribution Ireland is Graham Fox, and he's going to tell us all about Amundi's investment strategy as it affects ESG, and a particular survey they've done, Your Planet, Your Future, to find out what the resonance of these issues is across a wider audience. Faye, Walsh, Drouillard is beside Jerry here. She is the founder and general partner of WakeUp Capital, because of course startups and venture capital is also an important area of finance. And last but not least, we have Kathy Ryan, who's perhaps one of the largest frontline investment managers in this area. Kathy is head of responsible investment in Irish Life Investment Management. So maybe I just start with you, Graham, and work backwards and tell us from your own Amundi, Irish Life, and right across the board, WakeUp Capital and the association, how do you integrate all we've heard about ESG data into your investment decision making?
Thanks, Ivan, and good morning, everybody. It's great to be here. Excellent discussions already. It's a very, very broad question. From an Amundi perspective, we've spent a lot of time integrating the whole process of ESG into our investment decision making. So from the inception of our company, responsible investing has been a founding pillar of what we do. And with that, we've created a specific business line within the business. We have 40 professionals. We analyse over 13,500 companies around the world from an ESG perspective. And what does that look like? Well, we analyse every company from 38 different factors. So not just the E, which is obviously the primary discussion we've had this morning so far, but from also the S and the G side of it. What that analysis does for us is it allows us to scale every company on a scale of A to G. A being very, very strong when it comes to the whole area of ESG, G being quite weak, need to improve. From that perspective then, we have a team of research analysts who go in and engage with the companies, sit down, talk to the CFO, get down and dirty with what they're doing, areas that we can help them with, support them on, where they might need improvement. And Ashley made a great point this morning from Microsoft in relation to sharing industry experience. So that's one of the things we can do as an investor across multiple sectors. We can talk to companies and say what other companies in the industry are doing that they could look at to improve how they bring. So then from our perspective then, the end product for us is to create a fund which an end pension investor can invest in. So somebody's hard-earned pension that they save every month. That fund then, we provide funds that are deep green. You've heard this morning the mention of all these different acronyms. Deep green funds, which are very strong from a ESG perspective. So these are that invest in companies that have very, very strong positive impacts on our planet and people. And we also offer funds for people that don't have that view. You know, we still offer funds for people that don't want to go down the ESG route and want to kind of be in areas of the market that don't follow that as well. As a company, we're firm believers in the future of responsible investing. We've over 800 billion of pension savers assets specifically in this area. So we're one of the key biggest shareholders across the world in companies in this space.
Okay. Let's move along. Kathy, Irish Life. So there's many considerations when you're going to invest in whatever fund it might be or whatever company it might be. You know, the returns you're going to get. Where does the ESG fit in?
Thanks, Ivan, and good morning, everybody. Thank you for the opportunity to speak. So for us, I suppose, at Irish Life, this is a core part of our strategy. And, you know, the ESG, or responsible investment, it's a key driver at the moment for many reasons, not only from, as we've been hearing, regulation, customer demand, but for individual businesses also, how they're transforming their businesses. So for us, it's a key information set that we need to consider. And I suppose it's also very important as an asset manager to look at the valuation perspective. So for us, being long-term holders of both you know, equity and bonds, as well as property and alternative assets, it's important to look at how it's affecting valuations. So for example, this year alone in March, we saw Hino Motors, which is the trucking division of Toyota Motors, on the revelation of, again, an emissions scandal where they weren't disclosing correctly their emissions. The stock fell 17% on that day. Equally with scandals like Facebook, as you're all aware, on the day that the Cambridge Analytica scandal broke, Facebook made American history by losing 20 billion in terms of shareholder value, and went on to lose another 20 billion for the rest of the year as that scandal perpetuated. Similarly with Google, we saw back in 2018 when Andy Rubin left the company with a 90 million exit package on the back of a sexual harassment scandal. They had a walkout of 20,000 employees and were subsequently sued by a group of shareholders led by a pension fund in Sweden for lack of fiduciary duty in management of the company. And the shareholder group won and were awarded 318 million. So I think, one, for us, it not only reflects, I suppose, you know, key trends, macro trends that we're seeing, you know, across global economies, but it has very real impact on valuations. So for us, probably somewhat similar to Graham, we partner with a lot of external providers in terms of sourcing that ESG data sets. So we partner a lot with Sustainalytics and ISS, who are well-known companies in analysing thousands of companies and the underlying data sets that are really important for material issues for those companies. And we plug that then into our risk management and monitoring systems so that we can assess and tilt our portfolios to better rated ESG and companies with better rated climate outcomes to improve the sustainability outcome of our funds. Okay,
WakeUp Capital.
Good morning, everybody. Thanks so much for having me here today. Very passionate about the topic. I'm Faye, Drouillard, founder of WakeUp Capital. We're one of the first early stage venture funds here in Ireland, and we invest also outside of Ireland, focused on investing in sustainable and inclusive early stage businesses. I'm a recovering social entrepreneur, so it was very easy for me to join this panel. But I recognize for many of you in the room, having to think about ESG can be kind of exhausting. I know my husband, every time I bring it up, he works at a publicly traded company in aviation leasing, and he gets quite tired when he hears the letters E, S, and G. However, I think that this is just a natural evolution in the way that we measure and evaluate business performance. It's always been about the numbers, and now it's about a lot more. And whether we like it or not, we can do it for feel-good reasons, we can do it for regulatory reasons, we can do it because your grandchildren would love to have a planet when they grow up or afford a house, but it's probably here to stay. And I would just love to say that, you know, we've chosen to go into an asset class that, yes, is super risky, but extraordinarily important to help find some of the underlying investments that hopefully these funds will be investing in when those companies mature. And I think ESG is maybe we'll change the letters, but it's really an approach to risk and value creation, risk analysis and value creation for companies that just hasn't been on the balance sheet over time. So for early stage investing, I think what's great is we get to come in early. We get to look at companies across a range of different sectors and sustainability and inclusive businesses, usually B2B technologies, and help them think through how they're going to develop their ESG policy over time. And a lot of the companies we work with are impact businesses, which means they're actual solutions trying to solve these big challenges. So you can be an impact business with an ESG policy, but if you have an ESG policy, that doesn't mean you're an impact business. If anyone wants to talk to me about that at the break later, I'd be happy to share. It's a fun debate. But I would say that if you look at the markets right now in venture, as we all know, venture's kind of taken a bit of a dip, but climate tech investments have not. So we all know that this kind of technology and these early stage businesses solving problems that matter are here to stay. And I guess we take a view that if you can work with the businesses as early as possible to help them think through how their businesses operate, how they affect their environment, their community around them, how they govern themselves to be more sustainable and equitable and inclusive, their business performance will outperform others. It's hard to retrofit that. I recognize that we need to do that, and this is, of course, the hard job of my colleagues here, but we really believe at WakeUp Capital that getting in early to those companies, helping create them purpose-built, will help them sustain over time and create some of the solutions that are going to solve probably the biggest challenges of our lifetime.
Just to give us an idea of the scale, like is it 50 grand, 5 million, 50 grand, 50 million investment? What is the sort of scale of, when you speak about startup investment, what are you talking about?
So we're going to be a 50 million euro fund, working with the European Investment Fund, and the kind of investments we make, it could be anywhere, 500,000 up to 2-3 million. These are early stage companies, startups, pre-seed, seed, up to Series A.
Okay, excellent. Okay, so Jerry, you represent the IAPF, Irish Association of Pension Funds, which is the umbrella body, and so therefore, tell us a little bit about the profile of your membership. Are they Irish-based? Are they Irish satellites of globals? And where does the ESG push come to shove insofar as would you withdraw having invested in a fund if there was a non-compliance with ESG issues? Do you turn up at AGMs? How intrusive are you?
Yeah, I suppose as obviously being the umbrella body, we don't personally get into that, but at a general level, pension funds are obviously huge investors, globally and in Ireland as well. Even across Europe, pension funds invest about 7 trillion euro in assets, so they're big owners of stock, big owners of companies, so they've got a kind of big ownership role to play. The Irish market is slightly different in that Irish pension funds mostly invest through investment managers. So there's a bit of relying on your investment managers, such as Amundi or Irish Life, to do that work for you. I think when pension funds are looking at this, and like leadership-wise, pension funds have taken a real role in ESG responsible investment, where you've got a big pension fund, so in the Dutch market, in the Nordics, in the US and Canada. In the Irish market, because pension funds tend to be smaller, they're probably a little bit behind the curve. There are a number of reasons for that. I think pension funds always have this dilemma where their job really is to ensure they invest the funds of their members in a way that means they can pay out benefits in what could be 40 years' time. So there's a little bit of a natural reaction initially of, look, my job is just to invest the money and get the returns, and I don't really care where that's coming from. I think the next step, which often is driven by regulation, although regulation directly for pension funds is pretty light here at the moment, they just have to make a statement as to whether or not they consider ESG factors. So you can make a statement in your annual report that you don't take it into account. But I think, as discussion earlier, once you start thinking about it, actually it leads you to a different place. And then I think where they start to really embrace it is when they look at it initially from a risk management perspective. So it makes you think that actually, if I'm investing money that I want to be able to pay something out in 40 years' time, I want to be sure what I'm investing in is still going to be paying out in 40 years' time. So you start thinking about the organizations you're investing in. How is climate going to impact them? Are they well governed? What are they doing socially? And like all the conversations, socially is probably the one in the middle that it's a little bit weaker in terms of it's harder to measure. But you certainly want to make sure you're invested in well-governed companies that are adapting to climate change, that are moving with the times, and will continue need to be paying out over the long term. There's a next stage then where they can move on to, okay, well, that's great, and we decide what we're investing in. Depending on your motivation and who you are, you might decide there are actually certain things we just want to make sure we're not invested in because it either doesn't fit in with what our employer who's sponsoring the scheme does or what our employees would want us to be invested in. And then there's also a stage where a lot of schemes move on to stage, actually, I want to think about, okay, I'm paying out retirement benefits in 40 years' time, but what kind of world are those people going to retire into? And as a big investor, what sort of impact can we have to make sure that they're retiring into a world where they can get the benefit of their retirement pension? So that's kind of the ultimate stage that people get to. In terms of voting, because they're not direct owners of stock here, because you're doing it through your investment manager, what schemes are now doing is they're asking a lot more questions about their investment managers of, okay, what are you doing? Are you voting? Are you making a difference? Do you get to the stage where you either divest completely from something you're investing in because you're just not happy where it's going, or does it make more sense to stick with the investment and try and change the attitude? And that's that sort of dilemma that people have in terms of where they are. But it is really probably more relying on the investment manager to do the work, but making sure you understand what they're doing, and that fits in with whatever your policy is.
Cathy, can I ask you about that? Because we heard from Aidan quite a lot about how you might build up your portfolio management in ESG and in Article 9 funds. But in terms of stewardship and engagement, how active are Irish Life? You've skin in the game. How interfering will you be?
Yeah, this is a key area for us, and I suppose in mentioning how do we manage responsible investment assets, we've three levers as asset managers. So one is how we construct and manage our portfolios. Two is how we vote and engage on those companies, and that's a critical piece for us. And thirdly, maybe just to mention also, is how we engage with policymakers, industry bodies to set standards and to set frameworks so that we have a comparable level of practice and best standards, I suppose, that we can all sort of align around. But in terms of voting and engagement, that really is an area which is starting to drive business practice in a very concrete way. Just to give you an example, I suppose we have a bespoke voting policy where we vote on all of our equity holdings with a very strong emphasis in terms of how we have impact in terms of climate, diversity, and board independence. There are significant increases also in how that shareholder activism is acting out. So, for example, last year at Exxon, we voted against 3 directors, and we had them replaced with 3 other directors who had far greater qualifications in terms of the climate transition and in helping to align Exxon better with the climate transition than had previously been the case. Similarly, in the case of diversity, this year saw a huge number of shareholder resolutions, and we voted very much in favour of them, looking for clarity around the diversity and inclusion practices at major companies, such as at Tesla, DuPont, IBM. These all passed with huge shareholder support. Another area, I suppose, in terms of social, and I think it's particularly in terms of the social and governance aspect of companies where we're seeing a great shift in practice. There was a study done at Toronto Dominion across their North American practices and how their mortgage lending was equitable across different ethnic groups. And it was found, in fact, that comparing them with similar size mortgage lenders in the North American area, that really Hispanic and Black ethnic groups were very disadvantaged in terms of mortgage applications that were granted to those communities. And as a result of that, again, there was a shareholder resolution put forward that there would need to be a third party audit in terms of the policies and practices of their business products and how equitable it was for that for different groups, which again passed with huge shareholder support. And equal resolutions were passed at 23 other companies, including Apple, Goldman Sachs, BlackRock, JP Morgan, and so forth. So voting and engagement, in fact, is probably one of the strongest areas where we can have a strong influence as an asset owner and asset manager for those business practices. And maybe just lastly to mention, in addition to voting, collaborative engagement, which is where we collectively agree and form campaigns with other investors to see improvements in those business practices, is the other strong arm. So Climate Action 100 Plus, which many of you have heard about, is an investor-led initiative focusing on 167 companies who are the highest carbon emitters across the planet. That plan has been, or the engagement practice has been underway for 5 years now. And so far, 50% of those companies have set net zero targets. They're at differing levels of ambition and detail, but that is a huge improvement in terms of where we were with those companies 5 years ago. So, yeah, very important to those companies.
It's active stewardship and engagement. Graham, tell us about your survey with Amundi, Your Planet, Your Future, and what the takeaways from it were.
I'm delighted you asked me about this. I think one thing as an industry we tend to do, and you've heard great conversations today, is lots of acronyms, lots of big talk and high level stuff. And I know you're nodding there, Ivan, but I like to ask lots of questions of what we're trying to do. And one of the things our industry does do is make a lot of assumptions about what the end investor thinks or knows, hence ESG. So what we tried to do with this survey is we teamed up with Red Sea, and we surveyed over 1,000 people across all different socioeconomic backgrounds in Ireland, gender, unemployed, employed, right across the country of Ireland, to try and find the person that puts their hard-earned savings and pension in. What do they know about this space? We weren't interested in trying to find out, are people recycling more? There's great surveys out there have done all that, but the hard-earned savings and pensions, do they understand anything? Do you know what came back? 90% of the people don't know what ESG means. They don't even know what the term means. So we were saying, well...
Were you surprised?
No, not at all. But you know what's funny? We were saying, okay, as an industry, we've solved this, right? Because we talk to... Our marketing says responsible investing. We don't use the term ESG, we say responsible investing. So in this survey, we asked people, what do you think responsible investing meant? This is what surprised us, because we thought people know yet. The majority of people, almost 3/4 of the people, thought that responsible investing meant investing cautiously. It meant nothing to do with the planet, helping people, etc. So the key lesson for me is that these summits are so important and they're great, but the end investor still doesn't understand all this talk that we're doing today. The acronyms don't help. The way we talk about it doesn't help. But the positive thing is that over 80% of people that were surveyed said that they want to do better by the planet. They wanted to make their investment or their hard-earned saving into something that was improving the planet or the society that we live in. And just to hit the nail on the head on that one, we obviously did the survey on all different age categories. The age category that was most open to this was actually the older category. Surprising enough.
The people with the money.
The people with the money, yes, exactly. And in reality, we do talk about Generation Z and the younger people, and they know and they understand. Of course they do. And most people kind of knock us older people off saying, listen, they're not interested in this. The category that was most open to putting some of their post-retirement, their ARF money or their savings pot into something like this was that older category. And in fact, one of the things that's going to change, and has changed quite dramatically in the industry, Ivan, over the last couple of months, has been this, I'm going to use an acronym, IDD. It's the Insurance Distribution Directive. For the first time since August, if you sit down with a financial advisor or a broker to talk about your pension or your savings plan, they have to ask you questions now on your preference towards investing responsibly or helping the planet. So for the first time now, it's forcing the industry. So before, a lot of the time, a financial advisor or broker wouldn't ask you these questions. They'd ask about your appetite for risk, but they wouldn't ask about your preferences when it came. Now they have to. It's a regulatory requirement. So all the talk today about supplying more product and funds to help in this area, that's going to be hugely beneficial going forward as well.
Okay, I have 3 questions here because I'm going to go through these fairly quickly. We have about 10 minutes left. Someone is not listening. SSL KPIs, is there a flaw in the design that the metrics are measured and assessed annually and doesn't account for early wins and then they plateau in later years? So the metrics, the rating systems, some of the agencies involved, anyone want to take that? Are they fit for purpose? Can they be manipulated?
Go, sorry, Kate.
Yeah, I'll
You
jump
go,
in.
go.
I mean, the ratings, first of all, they've...
What is SLL?
SLL? I'm not entirely sure, actually.
God forgive me, how do I stick this? Anyway. Okay, nobody, okay.
ESG ratings.
Best piece of advice I ever got in life. Don't overestimate people's knowledge and never underestimate their intelligence. Right, the ratings agents, you'd be at this level in terms of, are they manipulative? Like, we're going to come on later to greenwashing. You know, people can have excellent spin, excellent perception in this area, but it mightn't be real. Like, you know, Ryanair say it's the greenest airline, and, you know, all the NGOs come out and say, nonsense.
Yeah, well, it probably is because all the others are terrible. So I think the issue with the rating, there are lots of issues with ratings. They're measuring different things in different ways for a start, and I think people don't understand that sometimes. There's a kind of view that, well, this company is rated really well by this company and it's rated terribly by another company, without looking at actually what they're weighting differently. I think there are huge efforts going in to have much more standardization. So when we talk about the different type of funds, you know, it'll be very clear that you have to meet certain criteria to whether you're going to be Article 8 or Article 9. I think all that helps, and it helps investors. So I think it's improving in that regard. But ratings are always difficult because they're looking at different things in different ways.
Patrick Flanagan asks, as investors, to what degree do you legally agree ESG performance indicators with the business you invest in? If yes, what do you do when they don't meet agreed ESG performance indicators?
Well, I could answer it just from an early stage point of view.
VC, yeah.
I mean, I think the reality is we're talking about ambitions to measure, but nobody really actually has a fantastic amount of validated data. And if you do, please let me know. I'd love to talk to you. So we can't go penalize people for screwing up yet. We can penalize them for saying they're going to do something and then they haven't really done it because they actually can't measure it yet. And that's really a challenge when you're trying to use rating systems. If you don't have the data on which to base a decision, how can you rate them? So I think we need to wait for time to pass. We need more capital deployed. We need a regulation to come in, and we also need standardization of systems. And just to use one analogy that's sometimes helpful, 100 years ago, we didn't have globally accepted accounting principles until we had a massive crash. So the world agreed we need to measure in the same way, P&L, balance sheet, in the same, and we all kind of came to a conclusion. I'm sure it took decades to perfect, and it's still being perfected now. And then we could look at today, we could say ESG or impact or whatever words you want to use as a correction to how we measure capital market performance. So I think right now we kind of need to give the ratings a break because we need time to pass, we need more data to be collected, and we need to really figure out what sticks and what works. We are in the beginning phases of this.
It's early stage. Yeah. Okay, I get that. Yes.
Even just about the companies, like engagement is extremely important, right? And we engage with the senior management, etc. But if over a period of time they're not changing, you know, you can see this in the conversations, and they're not doing what you think they should do. And we've divested from companies. It's the last option. It's the last option to do it. But at the same time, there has to be a point where you do look to say, well, actually, we've been going on this journey with you, and you aren't moving. So we're now going to pull our capital as a shareholder. So that is one of the extreme events where you would, you know, put it up to a company to say, well, look, we've gone on the journey. You've given us all the lip service. It's not happening. We're now going to have to think.
Okay. When we were talking earlier in the week, I think it was you, Graham, told me the story of the Californian Teachers Pension Fund.
No.
Which of you? Yeah, you told me that. I'm really interested in this story. My question arising, I want you to tell the story first of all. It's a 20-year story of an investor. And then secondly, you know, if I'm thinking about it, surely the conclusion of today is, from your point of view, I wouldn't invest in a tobacco firm. I wouldn't invest in Exxon Oil. I wouldn't invest in Paddy Power. I wouldn't invest in, you know, maybe Diageo, because there is a social irresponsibility element to it. Go figure.
So CalPERS, which is one of the biggest pension funds in the world, it covers public employees' pensions in California. They took a decision in, I think, the mid-90s to divest from tobacco. It wasn't an ESG-related decision. They actually felt with the amount of litigation coming down the road that tobacco companies were going to be under a lot of financial pressure and would not be a good investment. 20 years later, there was a bit of a sort of campaign started that actually tobacco companies had done very well. The financial litigation got sorted much quicker than anybody thought, and they kind of diverted into different types of strategies. So 2016, CalPERS did a survey or a kind of analysis, and they reckoned they'd lost $3.5 billion by that decision to divest. Now, CalPERS at the time, I think the fund was about $350 billion, so you're talking about 1%. They still voted that actually they weren't going to reinvest in tobacco, and that was an ESG-based decision because they just felt it was the wrong thing to do. But I think it just highlights, you can always have regret in investment decisions you make. Sometimes, you just have to be confident in the reason and why you're making your investment decision. And then, it may work out not as you thought it was turn out, but that's life in some ways. They'd probably invested some of that money in lots of other things that did really well as well and will continue to do so. So I think it is just that case of you really need to think clearly about what you want to do, what your investment policy is, and it may not work out all the time. I mean, people can be resistant to using ESG, and quite often you hear things like, well, ESG funds, some of those ESG funds underperform the market. But people happily invest in things like global equities, and some global equities funds will underperform the market. That's just, you can't look back with sort of investment regret all the time. But it's more about the decision-making and the process you have in terms of making the decision in the first place.
Where I'm going with this, Kathy, is that I have 100 grand, I've worked hard for the money, I invested in Irish Life, I want to get my, annuities in year to come. I don't want you to be a moral policeman. I want you to give me 15 grand a year instead of 4 grand a year. That's the deal. So where do you reconcile companies that are involved? I was shocked to hear you're invested in Exxon Oil, because surely that's incompatible. You should be investing in wind farms.
Yeah, so I mean, back to as an asset manager, the people who are making the decisions around this are asset owners, pensioners, large institutions. So those who are really calling the shots. And obviously, there's a huge degree of levels of interest in terms of responsible. Some that are highly ethical, certainly don't want tobacco or anything egregious in the climate space. And others that would like, a consideration of responsible investment without a huge deviation of what the normal fund would return. So hence, I suppose what we're seeing from the European Commission, it has been quite useful to get these guardrails, Article 8 and Article 9 funds. So you have one, Article 8, where there is a consideration of ESG, Article 9, which is deeply impactful. So I suppose in answer to your question, given this range of interest from asset owners, we need to have a range of funds available that cater to those, which is what we do. And we have a range of, high impact funds. So in terms of the Article 8, we have a climate solutions range of fund where there is no exposure to fossil fuels throughout the supply chain and a much higher allocation to green investments. That was really promoted by the asset owner who drove that investment. Similarly, with a large proportion of our funds, they're what they're called light green Article 8 funds, where there is a consideration and evaluation of ESG in order that is a critical information lens to ensure the return of the fund within a certain parameter. And I suppose a quick point on data, maybe just add in, because
yes,
we use data prolifically and it is key to this whole area. It has improved enormously. So, 5 years ago when we were evaluating a fund across maybe 1,500 holdings, if I had used 2 different data providers, MSCI or Sustainalytics, for example, I would have had results which were very different. So there's some argument to, as in credit ratings, there will not always be the same opinion in how well a company is transitioning towards climate goals, for example. But interestingly, within the last 5 years, the data sets have all tightened. So recently, I checked a fund on 2 different systems, 2 different data sets, and the results were surprisingly close. So what we can see is that through these regulatory bodies now who are promoting far more standardized information, the International Sustainability Standards Board and so forth, we are getting much more standardized data, which is allowing us greater comparability of similar companies within similar industries, so creating a much more level playing field.
Conor Dempsey has a question. How significant is the pushback against ESG from some legislators and some interest groups, particularly in the US? And I want to take that a step further. Politics. So if politics is driving this, if I was to say 3 years ago, the Nordic countries would all join NATO, that as we speak today, NATO are all going to double their defence spending. You know, the most unresponsible social thing you could say, all because of Putin. I mean, to what extent is some of this, you know, variable? Pushback, Conor's question. The world may change.
I think when you bring governments and politics into the equation, of course there is an element of variability depending on what is happening in the world. What's the awful events that are happening in Ukraine at the minute, and as you say, there's an increased spend in military hardware. Like, for example, we don't invest in cluster ammunitions, we don't invest in chemical weapons or the supply or manufacture of it and stuff like that. But these are potential areas that are being invested in as we speak. But I do think there's no getting away from the fact that the bigger issue for the world is the issue of climate change. Mm-hmm. The biggest social impact in the future will be what comes out of climate change, because the social of what's happening with the climate and the change in the extremes that we're going to experience in the weather and areas of the world that won't be inhabitable anymore, the impact that has in agriculture. Like, these are all longer term political events that are going to have to be dealt with. So for me, of course, in the short term, there will be events that will potentially push a little bit back on those things, but the longer term trend is there, and that's not going to change.
Okay, we're out of time. Does anyone want to add anything that you weren't asked, or anything that you feel is an important takeaway from the investment perspective? All right, with that, they want their coffee. I want to thank Faye, Graham, Jerry, and Kathy. They've all been fantastic panelists putting up with me, and thank you for your questions. Okay, so the format is we're going to take a tea break now. We're going to be back at around 11:50, where I'm going to have a fireside chat with a spin merchant, Dark Arts of Spin, about greenwashing, time washing, and green blushing. That should be fun. And then we'll have one further panel in relation to procurement and what we've heard in relation to Scope 3 emissions, focus on that. And then we're going to have lunch. And then after that, we're going to have the roundtable discussions. So I'll see you at the back. The bell will ring in about 20, 25 minutes. Do see our exhibitors around the building.